So how does debt help you create wealth in real estate? In this video, we're going to learn the difference between good and bad debt and how debt can actually help you increase your returns on investments and build your real estate portfolio faster. Coming up. Hey, what's up guys, it's Victor here with Dine's Development, bringing you the best tips, tools, and strategies to help you build wealth. If you find this video useful or you want to see more content just like this, please consider smashing the like button and hitting subscribe. So what is debt? Debt is borrowing money to purchase things that we might not want to pay for today. Most people, when they get into debt, they think about credit card debts, car payments, and student loans. Now, outside of student loans, those types of debts are what we call bad debts. So what is bad debt exactly? If the item that we're purchasing loses value over time, that's called bad debt. If you're getting to debt to purchase a new car, new clothes, it's going to cost you more long term because of all the extra interest payments. Now, a new car loses about 20% of its value as soon as you drive it off the lot. So now you have something that's worth 80% of what you bought it for, and you have to pay interest on top of that. Now, good debt is debt that actually adds value over time. We have to ask ourselves when we purchase things, does that thing actually make us more money? Does it make our life easier or give us more time? Both types of debts are still liabilities, just one adds value while the other loses value. With real estate tends to appreciate over time as well as it can cash flow. If it cash flows, it'll make us more money. If it appreciates in value or we purchased it at a discount, it'll make us more money when it's time to sell. Debt in real estate actually allows us to acquire more properties by borrowing money with a mortgage or a loan so that we can make more money, which is why it's considered good debt. By using debt, we can actually use less of our own money and more of the bank's money to acquire our properties. Now, if we're investing to real estate and we're investing long term, that means we're investing to create cash flow. Now, the amount of debt we acquire doesn't matter as much if we have cash flow from that properties or those properties. Now, I'm not saying to over leverage yourself and borrow too much, but at the end of the day, our mortgage payments are covered by the income that we receive by renting out those properties. So how does debt actually help you create wealth? Let's look at some numbers, and we're going to look at two different scenarios. Scenario one will be a property with no mortgage, and scenario two will be the same property, but this time with a mortgage. So let's say you're a property worth $400,000. You're collecting a rent of $3,000 a month, which is $36,000 a year. And our annual expenses are $4,800 for taxes and insurance, $2,400 for maintenance, repairs, and utilities for a total of $7,200. So our current income is $36,000 a year, and our current expenses are $7,200 a year. So your net is $28,800 a year. Now, if you put down the full $400,000 for this property, that means you're making a 7.2% return on investment every single year. Now, let's do the same exact numbers, but this time with a mortgage on it. If you put 20% down, or $80,000, your mortgage will be $320,000. At a 3.25% interest rate, you're looking at a monthly payment of $1,392.66, which we can round up to $1,400. That makes our annual mortgage payment $16,800 a year. So now we take our current income of $28,800, which is the number we get after deducting our initial expenses, and then deduct the cost of the mortgage per year. We end up with an annual income of $12,000, which is a 15% return on your investment of $80,000. So what do we learn from this information? By using debt such as a loan or mortgage, we can acquire properties more easily. Instead of saving up the whole amount of the purchase price, we can actually use the bank's money instead of our own. Because we're also putting down less of our own money, every extra dollar that we produce on that property increases our return on investment faster. So not only are we lowering the out-of-pocket cost of acquiring a property, we're also increasing our ROI and scaling it faster. So what are some of your real estate investment and tax strategies? You can leave your questions in the comments below and we can cover them in a future video. If you want to find out more about real estate investing, you can actually click on one of these two videos right over here. Make sure you smash that like button and hit the bell notification. There you get notified when our next video comes out. Anyways, this is Victor Zhao with Dyn's Development. I hope you guys have another great week and let's all be awesome together.